Welcome back, champions. Another mind-boggling stock news. Here are 3 proven secrets to profit from earnings announcements. Secret 1. Target 4 leading indicators of positive earnings surprises. The most obvious strategy is the reason we are all here. The 4 leading indicators referred to are the 4 factors of the stock's rank. Next week, 204 companies are set to report earnings. What if you could know in advance which few would shock Wall Street by beating earnings expectations and pop in price? Now you can. Proprietary ESP formula predicts positive earnings surprises with unthinkable 82.35% accuracy. Of course, not all picks can be winners, but investors following its recommendations have seen double-digit gains in as little as 5 days. Every day, we post stocks of the day on this channel. Do follow the Nemirian updates for right stock selection. Secret 2. Stop the bleeding. This second secret is simple, yet hard for most investors to do. Sell all companies with a negative earnings surprise. Yes, immediately. Do not pass go. Do not collect $200. Sell, even after it falls at the open, even if it is for a substantial loss. Why? Better to take a 5 to 10% loss in the short run than a 20 to 40% loss in the long run. Keep in mind how earnings estimates are created. Both company executives and brokerage analysts do their best to create conservative estimates that the company should easily beat. It's all about lowering the bar. So when a company falls short of those watered-down estimates, it points to one of 2 serious problems. Number 1. Industry conditions have deteriorated, and thus they miss their forecasts. This problem most likely will not correct itself in the near term, leading to further disappointment. Number 2. Management is incompetent, meaning that they are clueless when it comes to estimating their own earnings, or growth strategies are simply ineffective. Either reason is enough cause to abandon the stock immediately and move on to greener pastures. Secret 3. Harness real earnings whispers. Consider the following chain of logic. Number 1. Wall Street analysts create earnings estimates. These analysts are highly motivated to create conservative estimates that can easily be beat. Why? If they have a buy rating on a stock and the estimates are too high, then the stock is more likely to disappoint. This would send the stock price lower and the performance on their stock ratings would be poor, leading to lower compensation for the analysts. Number 2. The closer to earnings season we get, the more accurate the information the analyst has at their disposal to put into the estimate, since there is less time left to estimate performance. Add it all up and no analyst would increase estimates close to the date of the earnings report unless there was a darn good reason. Focusing on those estimates closest to the earnings announcement is where we've found the whisper that becomes a scream. A clear indication from the analyst community of stocks more likely to beat earnings by a wide margin. And most importantly, rise on that news. Did you find the information helpful? Let us know in the comments.